Hey guys, welcome back to video 4, and today we're going to continue to build out our plot with additional optimized portfolios. And then after that, we'll start to analyze these portfolios more and see why they may be practically unrealistic. So the first portfolio we're going to be constructing today is the tangency portfolio, but we first need to return to the PowerPoint and understand the mathematics behind it. So the tangency portfolio is exactly what the name implies. It's the portfolio that lies between the tangency of the efficient frontier and the capital allocation line. It's also the portfolio with the highest possible Sharpe ratio. So we're again minimizing the variance of the portfolio, but now our constraint is that the desired return on the portfolio is achieved by the expected return of W star in the risky assets plus 1 minus W star in the T-bill. You can also note that the full investment constraint is built into this expression. So we now form the Lagrangian and take the derivative with respect to W and lambda and set those first order conditions equal to 0. I'll be providing supplemental mathematical proofs for these portfolios, but considering they're just mathematical facts, I prefer to focus more on the coding. Anyways, we can solve for W star from the first order condition by moving terms over and multiplying by the inverse of the covariance matrix. Now we need to think rather than solving for lambda. Since lambda is just a scalar, it can't contain information on the relative weights of the risky assets. Actually, lambda in this case is just a scale factor that determines how much one invests in risky assets versus the T-bill. So if you want to maximize the certainty equivalent on the capital allocation line, then you're going to need to calculate lambda. Knowing this fact about lambda and that the tangency portfolio is 100% invested in risky assets, we actually don't even need to calculate lambda. Therefore, we already know W star from the first order condition we calculated with lambda as 1 and then divided by the sum of these weights in the denominator. Again, I'll provide more information on the proofs in the text portion, but we now move to Python to code and plot this portfolio. Okay, we're back in Python and are now just coding the optimal weight vector from the PowerPoint we just saw. We're first going to assign the variable WT and set that equal to the inverse covariance matrix multiplied by the mu vector. Just remember this is an excess return, so it satisfies our optimal W star expression. We'll then standardize the weight by dividing it by the sum of the optimal weights. And next, we're going to calculate the average return on the portfolio by multiplying the transpose vector of weights by our mu vector. And if we return this value, you can see the average return on the tangency portfolio was over 80%. And we're shortly going to address why this is just practically very unrealistic. And then finally, we need to calculate the variance of the portfolio. And it's calculated the same way we have by first converting it to a NumPy array and then multiplying the transpose vector of weights by the covariance matrix that is then again multiplied by the vector of weights. And we'll take the square root of that to get the standard deviation. And you can see that the tangency portfolio is seemingly achieving infinitely higher rewards for marginally more risk. And we'll address shortly what inputs are causing this irrational portfolio. We now return to our plot to add the tangency portfolio. We're going to do this in the same way as always by first adding the points to our scatter plot. So we'll add sig t and then mu t. And we also want to add text. So we'll copy that text down and just remember to change the variables. So we'll make this sig t and we'll make this mu t and we'll call the portfolio t for tangency. And if we execute this code, you can see the tangency portfolio looks like an outlier, but it is somewhere on the efficient frontier. But the reason why it looks like we can achieve infinite returns has to do with the estimation of our input, and specifically our sample means or our mu-vec variable. There's a large dispersion in those means, and the sample means over a short period of time, the 4 or 5 years we've been using, aren't reliable estimates of expected returns. So as we get into advanced optimization, we're going to look to address these issues, but for now, let's just reformat the plot and add the risk-free rate to make it more visually appealing. We now need to plot the capital allocation line, which is just a combination of the risk-free asset and risky assets. We're going to use the plt.plot function, and the first argument is going to be our x-axis coordinate. So we're going to start at 0 because we're in excess return terms, and we're going to go to the standard deviation of our tangency portfolio. And for our y-axis coordinates, it's going to be the same thing. We're going to go from 0 to the mean return of the tangency portfolio. And just for some aesthetics, we're going to change the color to K and the line style to a dash just to make it a bit skinnier. And for the width, we're going to make it 0.5. So if we execute this line of code, we can see that the capital allocation line runs from 0 to the tangency portfolio. And the efficient frontier will run up to the tangency portfolio again, creating a point of tangency between the capital allocation line and the efficient frontier. But this isn't visually very appealing, so let's go ahead and change the axes because the tangency portfolio isn't very rational. So we're going to use the ax.set_y_lim for our y-axis. And we're going to go from 0 to the max of our mu-vec plus 5, just to leave a little bit of room. And then for the x-axis, we're going to do the same thing. Just change it to the x limit. Again, going from 0 to the maximum of our standard deviation of our vector of the 47 industries. And then just add 5 for a little bit of cushion. And change those to zeros because it can't be an O. And you can see the reformatted plot is much more visually appealing. This is the end of this video on calculating the tangency portfolio. Make sure to check out the supplemental proofs at the bottom of the page if you're interested. But in my next video, we'll plot the last portfolio, which is the portfolio that maximizes an investor's certainty equivalent. And then we'll do some additional data visualization and analysis on all of our optimized and unoptimized portfolios. Hope to see you there.